Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. Joining me today would be the man himself. He's on their due diligence this summer. We wish Michael Becker and all of his colleagues over at SPI the best of luck on, I think he's bringing two deals. They're buying two more properties. So good for them. We wish them a lot of luck. In the podcast today, we have the professor himself, Mr. James Eng. James, how are you?
Great. Thanks for having me, Paul.
So, James, it's getting about that time of the year that we start scratching our head, thinking about ideas for the Old Capital Conference. Tell me a little bit about what's going on right now and all the prep that you're doing on the Old Capital Conference.
Yeah, I mean, this is our once-a-year conference for all syndicators throughout the U.S. And so people come in from all over the United States to visit us here in the great state of Texas. And there's a reason we don't do it in the summer because it's 110 degrees right now, but we push it out till September, October. This year, it happens to fall in October. So October 4th and 5th. So we have a happy hour the night before, give you a chance to get in. And I actually like the happy hour a lot. We added it a couple of years ago and gives us a chance to just hang out and just meet everybody. And then on Thursday, October 5th is the main event. This year, we are having at Frontier a Flight Museum over near Dallas Love Field. And the theme is, I guess our theme is Top Gun. And so whether you are just joining the ranks of apartment syndication or been here for a while, I think we're going to have a little bit different spin on learning about apartments and what's going on in today's market at this conference. And so we always have a good time. We've put together some videos so far, but I think we'll have a couple more the day of. So
yeah, we'll include the newest video that comes out, which is just the introductory inviting you to come, whether you're a maverick that you've been flying for 30 years or being part of a syndication, or whether you're a general partner or limited partner. I mean, you can always learn something at these conferences. But if you're just a brand new person looking to get into multifamily, we want you to come. So this is the time to educate yourself about what's going on, where the market is right now. And then also is make those connections, because it's really a conference of networking, being part of a bigger group, because we buy these properties as teammates. So Maverick and Top Gun, he had a bunch of teammates that he counted on. He had a bunch of wingmen. So that's what our theme is that we want you to become the Maverick. We want you to become the best of the best. And so we look forward to seeing you at the Old Capital Conference. James, again, the best way for people to get tickets, because we have limited seating at this conference. I think we're expecting over 600 folks. James, what's the best way for people to get a hold of tickets?
yeah, if you just go to oldcapitalconference.com, it'll have all the information there, and you can register and buy your ticket online right there.
So we always, every once in a while, James and I, we're on the phone with each other once or twice a day, just kind of talking a little bit about the market, talking about some of the clients that we've done loans for at Old Capital. Again, remember, Old Capital is a commercial real estate lender, and we do a ton of business. And so we do a ton of business in the Southwest, but primarily mostly in the Texas area, whether it is Dallas, Fort Worth, or Austin or San Antonio. We do a lot of business. And so over a period of say 30 plus years, now I'm starting to say 30 plus. I don't want to say 38 anymore because that's starting to make me look too damn old, James. So I'm going 30 plus these days. And maybe next year I'll go with 25 plus, then start working my way down. So I look like a youngster in the business. But we've learned a lot of lessons about what has happened in the past and what is happening today. And we just kind of want to have just a general broad conversation that we want to have you be a fly on the wall while James and I can just kind of pontificate and talk a little bit about what's going on. So hopefully you can tighten up what you're thinking just based on some of the information that we're going to be talking about. So I have some thoughts, and I know James has some thoughts too. And So let's try to get into it. James, any initial thoughts before I begin my 2 cents?
Yeah, I mean, I think overall, let's just start maybe on the acquisition side. There are some deals out on the market, but I mean, back in the heyday, I would say 2 years ago, we might have 50, 60 deals on the market. And it was almost like there was too many deals in the market. Like people didn't know what to look at. There were so many deals, and every one of the deals had 30, 40 tours, 25 bids, and people just flying in. It seemed like every week putting in new offers and just a lot of activity. And now in the market, I mean, just with the rates higher, with the number of sellers and the valuations that the brokers are telling them, they're saying it's not time for me to sell right now. And so a lot of sellers are just holding off. And a lot of buyers are saying, well, the interest rate's high. I can't get a cap rate of 6 or 6.5. And my debt's 575. So I'm just going to hold off right now. And even if I did find a deal, it'd be hard to raise the equity. So all of those things coming together on the transaction side, I mean, across the board, whether it's 50%, 60%, 80%, I mean, all these brokerages have different numbers, but it's down significantly just in terms of transaction volume on the acquisition front. So I'd probably start there. And then on the ownership side, the guys who own these properties, I mean, they're definitely hitting some headwinds just with rents slowing down. Here's a little story. I talked to my sister who lives in Austin yesterday, and she had to move places because her rent went from, let's call it $1,500 to $1,800 on a Class A property down in Austin last year. This year, she got a notice, no increase, nothing. All we want you to do is renew. So just in 1 year, it's flipped that fast on these rental increases. And so, whether people's occupancy is a little bit lower, they're not pushing the rents as high, people are starting to change their strategy. I mean, I just saw a post on LinkedIn. Somebody was like, all right, how do I optimize my occupancy right now? Right? Because it's saving money, not only on the turns and the vacancy factor and all those things. People just don't know how long that unit's going to sit. And so people are changing up their strategy a little bit compared to last year. And so that's some of the things we're seeing just on the acquisition side and the ownership side.
So a couple of things I wanted to talk about were just different ideas in multifamily investing. Again, this is a broad topic. So to be successful in this business, and I mean the apartment syndication business, as GPs, we need to do two things well. And I mean really well. One, we need to find new deals. And two, raise money. So today we're challenged on both sides. And just like James was saying, it's volume of business is down, but also to the finding opportunities out there to actually buy transactions is tough. And so I think that we're going to be challenged a little bit, but I really want to talk about the severe challenges in raising capital. And so how locked are you in with your investors? I closed a deal recently that required $6 million in total equity. Half the equity came from an exchange. The rest needed to be raised in a syndication. So they raised a lot of money, but they were about $500,000 short to close. It took them over 3 weeks to raise $500,000. Yes, 3 weeks. In my world, that's a long time. So that's like having 5 investors, new investors put $100,000 each, or 2 investors putting $250,000. So it's challenging in finding equity sources in today's market that are wanting to say goodbye, invest with their hard-earned money into your deal. So the stock market's been on a tear. The money market accounts are paying 5.25%. So I think what we really need to focus in on is raising equity to purchase apartments. We need to focus on how do we do this? So I think sponsors, before you go too far down the road, when you consider about buying something, you got to consider how far is your equity locked in? How far are they investing with you? So here's a couple questions that I don't have answers for, but things that I know that you're hearing out there. And I kind of want to think as a team of how we kind of answer some of these questions. We're hearing LP investors asking today's GPs, I can't invest any more money into your deal because I really don't know how much liquidity I will need in the future for future capital calls on deals I'm already invested in. Or I'm making a guaranteed return on my capital right now in money market account. Why do I want to invest in XYZ apartments with you. Or I'm new to apartment investing, but I've read a bunch of syndications are in trouble. And my uncle invested $100,000 in a deal in Jacksonville and lost his shirt on the deal. So how do we answer some of these tough questions? And what are you saying to bring equity into your deal? And again, I don't have any answers to these questions, but maybe James and I can just kind of pontificate a little bit about trying to answer some of these questions. James, what are you seeing some of your syndicators out there trying to answer some of these stumbling points that we really didn't have 18, 24, 36 months ago?
Yeah, someone posted on LinkedIn, a syndicator in 2021 flying a plane blindfolded. And that was the world in 2021 of a syndicator, of what it took to succeed as a syndicator. And then in 2023, it was a split screen, and it was like the whole NASA flight, all of Houston, Texas.
The whole control room.
Yeah, the control room, to analyze all these numbers and figure out a way to, some of those things are true, right? So, when interest rates go from 0 to 5, that's not just a 5% increase, it's a 500% increase, right? And so it just is a huge difference, and it resets where debt is, it resets where equity needs to be. And it's moved so fast that a lot of these valuations are a lot harder, right? And so in this space, a lot of people, obviously you can paint, a lot of people are painting commercial real estate with a broad brush, saying that the world is over for commercial real estate, right? But then really, how does office compare to apartments? Very different. How does a Class A office compare to a Class C apartment? Very different, right? So I think you have to drill down a little bit, because on some of these deals, we're seeing people still go hard with money on these stabilized, occupied deals. They're still going for big prices, and they're still having a lot of tours. But then let's say a C deal that's 70% occupied, it might be sold for the debt. Right. So the equity's wiped out on some of these deals, and they might even get foreclosed on some of these deals. And so there's really, we always say the bifurcation of the market a little bit. In 2021, it was one market. Everything was a 4 cap, right? And now we're seeing a splitting of the market where there are still Class A deals trading at 4.75, 5% cap rates. But then some of the C deals out there, they're not trading at all. Right? Because nobody is willing to step in at a 5.5 cap rate right now, or they can't get debt at a reasonable interest rate on a deal. And so
somebody's writing a check. It's whether it's the seller that's going to write a check to get out of this deal, or it's going to be the buyer writing a check to put money into this deal. So somebody's writing a check these days.
Yeah. What we're seeing is, majority of the bridge loans were done in 2021, and a lot of the deals were 3-year bridges. So there's going to be a lot more activity, I would say Q2, Q3 of next year in terms of maturities. But then some of those loans that were done were 2-year bridge loans. And those are the ones that are having issues right now. And those sellers have to make a decision. Do I refinance the asset and bring money to the table to refinance these assets? Or do I sell right now? And the sellers are used to walking away with big checks or big wires at the end of these closings. Some of these sellers are going to have to bring money to the table to close out some of these deals.
Yeah, 100% correct. And so here at Old Capital, we have a couple of things of the Old Capital. What do I believe? What do I believe? So we want to be a dollar cost averaging into the market. So some of these properties were bought at a higher amount. Now they're going at a lower amount. So when you dollar cost average, just like when you bought IBM at $100 and now it's down at 50, if you buy it today at 50 and you dollar cost average, and it's like buying it, I guess, at 80. The 100 brings it to 80 and the 50 brings it to 80. So you're buying maybe a good company, a bit good property at maybe a lower price in a good industry. So invest with good operators, not their first rodeo. So maybe talk a little bit about, of what you've done in the past, and then show that you're going to have enough liquidity for a rainy day. So have more than enough liquidity. Continue to maintain the asset. That's what good operators continue to do. They may not make distributions, but they may continue to put money into these deals. And this, like Michael Becker's rule number 1, buy in good areas. We're buying in good areas. So communicate that over and over and over again. And when you do if people want to talk with some of your investors, make sure that you're overly communicating with your LPs about what's going on with the current transaction so they can say good things about you. And then take the longer term approach in investing in real estate. So yeah, values may be down, interest rates may be higher, but this is just a temporary deal over a period of time. It's a little bit like a yo-yo going up and down while you're on the escalator. So over a period of time, it's going to be higher down the road, but today it may be down a little bit. And of course, don't be a momentum investor. So many people in the last, say, 10 years have been momentum investors. They haven't been taking the long-term approach. And what I really mean by that is, and I'll let James chime in a second, is that I've really said this is really a 90-10 deals, not 90% occupancy, but it's really 90% of the deals are being done through syndications. So if you went back 50, 40, 30, 20 years ago, 90% of the apartment investors were three rich guys / gals. That's who were buying these properties. Now, these properties were valued a lot less than what they are today, but it was three rich interconnected. My brother-in-law, my sister-in-law, myself, somebody was the operator, somebody had lots of money. We all bought these properties together. Three rich people were to do it. Fannie Mae was around, but most regional banks did the lending. Banks usually required the sponsor to have a large interest in the deal, like over 50% of all the equity was coming from the sponsor. That's the one that was signed on the loan documents. The bank wanted to know who was at the helm, who was making the decisions. Banks didn't like a sponsor, the one that signed the loan documents, that could possibly be fired. So they don't want the crew to come in and fire the captain. They want to make sure the captain stays because he has the largest equity ownership of the deal. And so at the time, syndications were really not available. So 90% of these deals done 50, 40, 30, 20 years ago, up until 10 years ago, were all these small groups buying it. So banks really did not like the syndication deal. They didn't know who signed the deal, who was liable for the debt, who was going to bring in the additional money to cure a problem. But about 10 years ago, the syndication model took off. So prior to that, Fannie didn't like it because they couldn't understand how unrelated investors would support a deal that came into trouble. Because that's really what we're trying to do is mitigate the troubles. So we had to walk through with Fannie to have them understand what a syndication was. So a lot of them understood it, but they didn't understand that now we have, instead of 3 or 4 rich guys, now we have 30 or 40 people that were investing money into these deals. And that it was actually better because you could raise additional equity in the future if you had a rainy day. So instead of counting on the 2 or 3 rich guys, we can count on the 30 or 40 LP investors that could come to the table with the additional money if it was needed for like a capital call. So we made the argument, and I'm talking about Old Capital, in groups like Old Capital made the argument about 10, 12 years ago that the syndication model with Fannie and Freddie was good, and that kind of took off to where it is today. Today it's 90-10, but it's the 90% syndication and the 10% rich guys. And because of the syndication through Fannie and Freddie allowing it, the genie is out of the bottle. So prices have gone higher than at any time. Rents are higher, operating expenses are higher, and either higher property taxes or higher insurance. And there's no doubt that insurance is one of our challenges here in the Southwest, is that it's almost doubled. We heard of a client yesterday that had their insurance go for what is it, $600, $610 or so, up to $1,300, James? Did I hear that correct?
Oh, yeah.
So insurance has just been a trouble deal. Any comments on that, James, since you were an underwriter and you've kind of seen these deals come together in syndication?
Yeah, I mean, when everybody's poor, it seems like. So when everybody's making a ton of money, when you pass the hat around, all the money just falls out of the sofa cushions. But nowadays, it seems like if you do go out and try to raise money, it's just a whole different environment right now. And so when people are going out with these capital calls, I mean, the GPs on these deals, if it's a $5 million deal, the GP team can maybe support it. When it's a $50 million deal, after a couple of months, that interest payment is pretty difficult to float from a couple guys. And so, we're hearing, syndicators have tried to sort of keep the water out of the boat, keep this thing floating, but they're having to go back to their limited partners now. And I think we had Neil on a couple months ago or maybe a month ago about capital calls, and we're starting to see it everywhere now across all groups in terms of having to go back to the limited partners, because a majority of these deals, they were set up to be for 2 or 3 years, and people bought 2-year interest rate caps, and now you blink and it's already been 2 years and you have not hit your plan. And so if you've not hit your NOI and you have not hit that 8.5 debt yield to refinance out of these deals into agency, then you've got to do something, or the lender / crypt keeper is coming for you very shortly. We are not to Halloween yet, but somebody's going to be knocking on that door, and it's not going to be anybody that you want to answer.
Not at all, James. Let me just tell you something I thought was interesting, and I found this because I think it aptly applies to where we're at right now. In the year 1519, explorer Hernan Cortez, so explorer Cortez, arrived in the New World with 600 men, and upon arrival made history by burning his ships. This sent a clear message to his men: there is no turning back. 2 years later, he succeeded in his complete conquest of the Aztec Empire. So when Cortez arrived in what is today Mexico, his soldiers did not want to fight. They were tired of the voyage, the natives were not friendly, and it was a strange land. Cortez, who wanted to conquer this new land, would have none of it. To motivate his men, he burned his ships to the waterline. They were now all faced with a stark choice: fight or die. Fight or die. I think that is aptly applies to where we're at right now. So we've had a lot of people that, let's say, left the old world and sailed on the multifamily ship to the new world, and they've done very well with the new world, but now they're going through some troubles, and they think maybe that they want to depart back to the old world. That is not the way it's going to be. You've made your bed, now you have to lie on it. So we have to kind of figure out together of how you're going to do this. How are you going to stay in the apartment syndication business? So you got to keep your nose clean, just like I was talking about before. You do two things: when you find new assets, and you find new money to put into these deals. But if you have a problem with Fannie Mae and Freddie Mac, you're going to have a problem in the syndication business. So you got to keep your nose clean with Fannie and Freddie and with all lenders, or you'll be a dead in the future of doing syndication business. So if you give a property back with the deed in lieu of foreclosure, or you actually had the lender take the property back with a foreclosure, you need to do everything you can to keep the property going. And that could mean a few things, like just what James was saying. Sell the property, like we were talking about. Sell it as much as you can. Try to get the loan paid off and distribute. If there's anything above whatever the loan amount is, distribute the funds to the LPs. It wasn't what your original business plan is, but now you're saving, say, your ass to fight again. B, raise additional equity from LPs in or out of the current deal to keep the deal from going bad. So you may have to raise some additional money to keep these deals going, because you may see the churn at some period of time and you need to have additional money to keep this thing going. Continue to talk about capital calls. So what James was talking about with Neil, go back and watch Neil's presentation about how to raise money. Do everything you can to keep these deals going. If you want to refinance to a Fannie Mae, Freddie Mac loan, you may have to pay down the balance. Now, it may be a large pay down just because we need a 125 debt coverage ratio on these deals, but at least maybe your investors have a plan of what they see. That if they see that they can pay it down by $4 or $5 million or $300,000 or whatever that number is, at least have a plan of what can happen and then rally around the plan. And if it's not Fannie Mae or Freddie Mac, then refinance to a 35-year, 118 debt coverage FHA loan. So I like that option just because you can try to get higher loan dollars, but it does come with, say, a 10-year step down prepayment penalty. And there's other things, and it does take maybe 5 or 6, 7 months to get that loan approved and closed. But I like that idea of that long-term fixed rate and the ability to put it in a box, maintain the property, put it in the bottom drawer, and then 2-3 years from now, take it out and then sell it or have somebody assume that loan on the property. So a 35-year FHA loan, they've stopped doing the 35-year Fannie Mae loans, but the 35-year FHA loan may work. And the last option is that if it can happen, refinance to another bridge loan if possible. James, any ideas on that?
Yeah, I mean, a lot of these, it's time to get the pen out, and you're going to have to write a new story for a lot of these investors who are putting money into the deal. This is not the same story that you gave them 2 years ago. So you're going to have to come up with a new story of why they should support this asset. So that's number one. And then if you are doing a refinance and you are, I mean, so the reality is a lot of these bridge loans, you know, it was 80% levered. At the time, Fannie and Freddie would have given you 60%. So that 20% gap that in your equity stack, that was always there. It's just that now that bridge guy is gone. He gave you 2 years. You couldn't make it happen. Now it's time to go to agency. And so you need to raise that additional 20% in equity in order to get it to agency right now, to give you more time. And so you're going to have to write a story for your limited partners. If your limited partners say, well, I don't like the story, and you don't raise all the money, then you're going to have to write that story for a pref equity provider. And that pref equity provider is going to look at you and say, all right, what's going to change? So you've had 2 years. Now what's going to change in the next 2 years if I give you this money? And the same thing for the bridge to bridge is, all right, what's going to change to go from your existing bridge that's been 2 years, and now I'm going to give you another 2 years? How are you going to change this property and get it to an agency loan? And so having a story around what you've done over the last 2 years in terms of CapEx, what this money is going to do to bring the property up, I think is going to be very important to make sure that you get this additional money to save these assets.
Yeah, you were out at a property yesterday, James, and what was on the front door of that property? Because I think
Front door was just a sign saying, hey, the management company is changing. Please direct all your payments. Like, we're coming up to the end of the month right now for July, our July 1st payment. Make sure to send it to this address, please. Do not send it to the old guy, send it to the new guy. And so a lot of times there's got to be, like, whether the management company is to blame or not, some of these owners are having to sort of change their change the players on the field, right? So we've got some management companies who have done okay, but now this is not a time where if your NOI is flat or your NOI is down, that you can make money in this business. You've got to increase your NOI to make money in this business right now.
Why that's interesting too is because James walks up onto this property, looks at the front door, and again, there's nobody in the office. The door was locked. But this is like an institutional type of property. I mean, a nice asset. And it was bought by a syndicator that owned the property. And we're like, why would that big syndicator who usually self-manages these assets go to a third-party property management company and just put a big sign on the door? Was it them that made that decision to do that? Or was it somebody else that made that decision to deal with it, to change property management companies? And at the end of the day, my feeling is it was the lender that made that decision to change property management companies. Like just like a football game that we're playing that everybody's in the middle of, we got to bring this player out and we got to put somebody in new that maybe knows the area better than you that is doing syndication from another state that trying to self-manage this deal from outside the area, that the lender says, I've had enough of that. That person's fired, so to speak, which is you, the syndicator. Your self-management company's out, and now I need to have somebody that kind of knows what we're looking for, and we're going to hire them. And that's they're forcing their hand to change it. Now, I could be completely wrong, but I don't think so. I think what's going to happen is that, just like James saying, what is going to have to change in this deal for this thing either to make more money or put in us position that if we're going to take this property back, that we kind of want to make sure that we know what the books are and we have a third party that's analyzing the books for us. Anything more on that, James?
Yeah, I mean, what's coming down, it's, a lot of people, I think if they have 3-year bridges, I think their head is in the sand right now. They're just saying, I don't want to hear anything. Don't even, brokers are calling them saying, do you want a BOV? No, I don't want a BOV. I know the value. Value's no good right now. Do you want to talk to your limited partners? No, I don't want to talk to my limited partners right now. So their head is in the sand right now. And wake me up next year when my maturity is. Hopefully interest rates are down. So I think a lot of people on 3-year bridges are just saying, I can't do anything right now. Can't refi, can't sell, can't do anything. But the guys on 2-year bridges, stuff that is coming up this year, they're having to go right now. And I think that's going to change the market. I don't know how many deals it's going to be. I think it's definitely going to be a little bit heavier in Houston, maybe even a little heavier in Austin in terms of deals that people are just going to start going off market, and people are going to buy it for the debt. And we're going to see it. Basically, we get an email every week that shows us all the sales, and we usually see the sale price and we usually see the loan amount. And in the last 10 years, every time the loan amount on every sale is higher and higher and higher. And now we're going to see that loan amount come down from the last loan amount. And that's when you know that somebody sold it probably for a loss. You don't know if all their equity is wiped out, but you know some of it was wiped out probably. And so we're going to start seeing some of those transactions come up. Some of those are going to be distressed assets that you're going to have to do a bridge loan on at 9 or 10%. But some of them are just going to be Fannie Freddie loans that someone's willing to, let's say the loan is $20 million and Fannie and Freddie can only give you a $15 million loan. Well, the new person coming in buying it at 20 million, that's no problem. They're resetting the basis on the deal. So I think we're going to start seeing some of that come up here in a little bit.
I think the opportunities are already starting to come, James. Let's end this on a high note for some of maybe the new investors out there. And so we talked a little bit about at the beginning is that, again, you got to be finding properties and you got to be finding equity. Well, this is, I think, finding the properties piece of the deal. And it's been challenging the last, say, year or so to find, say, good deals out there. But now if you're brand new to multifamily or want to get into it as an investor, I use the analogy all the time about an airplane. We have the pilot, who's the general partner, and we have the first officer, which is maybe some key principals that are sitting there. And then we have all the passengers in the back, and they're the ones that are waiting for their plane to take off from Cleveland. Those are the limited partner investors. And right now we have too many pilots and not enough limited partners, passengers in the back. In fact, the pilots are going in and becoming limited partners to a certain extent because there's not a lot of deals out there and they're trying to fund their own deals. But we need to have, for every one or two pilots, we need to have 50, 60, 70, 80, 100 limited partners sitting in the back rows. And we don't have that right now. But let me talk a little bit about where's some of the opportunities. And so we have some inside information about what's going on. So we are starting to see the opportunities are starting to come. I know we spoke about this for the last few months, but we are just starting to see distress opportunities coming into the market to sell. Not from the small syndicators, but from the large syndicators. And I wouldn't think that you would say they were household names, but you've seen them on LinkedIn or Facebook all over the place. And I'm not going to go mention any names or properties, but we received some inside information that a few large properties are coming to the market shortly. And that's going to be a tell that these properties were bought at a high sales price about 30 months ago with high leverage, and now has much higher interest rates with higher operating expenses like property taxes that have gone up tremendously and insurance premiums that have almost doubled here in Texas. These syndications could be selling for whatever the loan amount that's held against it or a greatly reduced limited partner equity position. So a lot of these syndications are just out of money and they want to get out before the rush comes in. So right now we're starting to see a couple large syndications checking the market to kind of figure out what can we sell these deals for right now. James, anything more to add to that?
No, I think as a buyer, you just need to be ready. I mean, have the equity ready, have the debt ready, have your team ready, because they're going to take it to 3 or 4 people, and whoever gives them the certainty of close. I think in 21, 22, no one really worried about debt financing because there was 10 bridge lenders at the door and equity was falling out of people's pockets. It was coming from the helicopters that the government was dropping money from. But now, I was on a best and final call this week, and the number one thing they're scrutinizing is where's the money going to come from? So unless you can show me an account with all the equity, then I don't believe you. And so you're going to have to tell your story on your track record of raising money, how much money you've raised, what the distributions back to your investors have been. when was the last time you raised equity? I understand you raised equity in 2021, but have you raised any equity this year? And how are your deals doing currently? And so some of these seller interview calls, before they go to the dance with you, the interview process is a little bit longer than usual.
Yeah. So James is 100% correct. We were on a call last month with a large real estate investment trust that was selling an asset. And the number one thing that I learned on that call, that I'm passing that level of knowledge on to you, is, the word syndicator was a great word to use 2-3 years ago, because that meant for the seller, again, these are seller generated calls, because the buyer's trying to buy their property. Seller wants to hear the game plan and kind of figure out, can I trust you? Can you bring the capital to the table? Well, 2-3 years ago, it wasn't an issue. 5 years ago, 6 years ago, it wasn't an issue to raise capital, because if you said you were a syndicator and you needed to go up by $300,000-$500,000 to capture the flag, to buy the property, to win the deal, then you just had to go out and syndicate another 3 or 4 people to throw in $150,000 each to put into this deal. Today, syndication is kind of a bad word, especially with the institutional investors. Just like what James was saying, is that we have to be very careful what we say in these seller-generated calls. I don't think we want to say that we're a syndication model, because they're going to get asked that same question. Is that, where's the money coming from? Do you have exchange funds? Did you sell something? Do you have committed capital? Who's signing on this deal with you? What's their liquidity? What's their money? Where's that all coming from? So it's really a challenge to say syndication right now. So maybe you would change it up and say, I'm an operator, we're a small family office, or we sold a deal and we raised the capital. Find ways to be more clever and then saying syndication. What would you say out there, James, on that call?
No, I mean, it's definitely tough. I don't know if I have a word for you quite yet, but what I recommend typically is figuring out how much in proof of funds you can show, and showing that your general partnership team can, if there is a shortfall, can put the money in to close the deal. And one of the things that the seller asked was, well, if interest rates go up, can you still make up that gap? And how much it goes up, and have sort of figuring out exactly how much equity you need to raise on this deal is important. And if you've done it before, I think is key as well, and how much you distribute it back to those investors. So I think that's the most
Always
important
love listening to the professor giving us some guidance about what's going on, and where that all comes to. Like, this is a funnel. That was the top, down to the bottom. You want to come to the Old Capital Conference coming up here October 4th and 5th. Again, why, James? We bring all these things up because you'll meet and network with people that you want to do business with. You want to be exposed to the market. Give me 2 more reasons, James, of why to come to the Old Capital Conference.
Yeah, I mean, I would say 2 years ago, I mean, majority of the deals, they were listed on, the broker's website. It sat up there for 2 or 3 weeks. You did 40 tours, and then they chose a buyer after a couple of rounds of best and final. Now it's, hey, I have a maturity in 2 months. Bring me a buyer right now. Broker's making a call to 2 or 3 guys, and you want to be on that list, and you want to know those brokers, and they want to see that you're active. And so I think that's one reason to be there, is just to shake hands with everybody in this marketplace that you want to know, number one. And then number 2 is, a lot of these deals, I'm not saying that you have a sixth sense, or, when you meet somebody in person, we've seen some of these syndication deals go bad. And I don't know if all those people met those syndicators that they invested with. So I would say, come out, meet not only 1 or 2 syndicators, meet 100 syndicators, meet 100 investors in these deals, and talk to the general partner, and then talk to other LPs about how their deals are going. Because that inside information is very difficult to get. There's only so much that you can get online, quote unquote. There's a lot more that we can say in person than we can say on this podcast. So that's why you got to be there.
That's great. That's great. All right. We'll finish the podcast by saying thanks for listening. We appreciate that. Again, we wish Michael Becker and his group over at SPI a great deal with his 2 new acquisitions that he's working on right now. James, the Professor Eng, you'll see him at the Old Capital Conference. We'll see you hopefully at the Old Capital Conference here in Dallas, October 4th and 5th. And we appreciate your time. Again, I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.